Hi, this is InTech Investments. Before we get started, just a quick note. This video is for entertainment and educational purposes only. It should not be considered financial advice. Always do your own research and consult with a professional when making investment decisions. Is the current AI market the next big boom, or are we heading toward a spectacular bubble bust? With the $370 billion being poured into AI infrastructure globally this year alone, and companies like Nvidia seeing their stock price increase over 170% in 2024, this question has never been more critical for investors. Today, we are deep diving into Azeem Azar's groundbreaking 5-gauge framework that separates AI boom from bubble, and some of the results may surprise you. I'm going to show you some metrics to monitor how to spot the warning signs and why investing in the Magnificent Seven carries different risks than AI startups. Let's start with the framework first. I discovered this from the AI Daily's Briefs video, The Truth About AI Bubble, covering a piece written by Azeem Azar, the creator of Exponential View, and a technology analyst who developed this comprehensive system to answer one simple question. Is AI in a bubble? The critical distinction between a boom and a bubble. A boom is characterized by rising valuations and accelerating investment, where fundamentals such as cash flows and demand growth eventually catch up to justify the initial optimism. A bubble, by contrast, is far more specific and destructive. For the purpose of this analysis, we define a bubble by two primary criteria: a 50% drawdown from the peak equity value that is sustained for at least 5 years, coupled with a substantial decline in the rate of productive capital deployed, also collapsing by approximately 50% from its peak. The table on screen crystallizes this distinction. Unlike the typical, I know it when I see it approach, Azar's framework uses 5 specific gauges, like instruments on an airplane dashboard. Here's what makes this brilliant. He studied every major bubble in history: the railway mania of 1840s, the telecom crash of 2001, the dot-com bubble, even the housing crisis of 2008. His conclusion: 2 red gauges equals trouble. Currently, we have just 1 red gauge, but let me show you exactly what that means. The first gauge measures how much of the economy depends on the single technological bet. Think of it as the economic strain gauge. Right now, AI represents 0.9% of US GDP. That's about $259 billion out of America's total economic output. Azar's thresholds are the green zone, 0 to 1% of GDP. We're here on the higher end of that. The yellow zone, 1 to 2% of GDP. And then the red zone, any above 2% of GDP. For comparison, the railway bubble of 1872 hit 4% of GDP just before it crashed. The telecom boom peaked at 1%. We're still in the green, but we're heading towards yellow soon, with Goldman Sachs projecting 17% growth in 2026. What's particularly interesting is the depreciation factor. Railroad tracks lasted decades. Some US freight trains still run on 19th century tracks. But AI hardware? GPUs age in dog years, with only 3 years of useful life for frontier applications, and this creates both risk and opportunity. Here's where we hit our first warning sign. The industry strain measures how much companies are spending on equipment versus how much revenue they're generating. The current AI sector has 6 to 1 ratio. For every $1 of revenue, $6 are being spent on capital expenditure. That's higher than both the rail bubble, which is 2 to 1, and the telecom bubble, 4 to 1. But here's the nuance. Gen AI revenues are estimated at over $60 billion this year, up from essentially 0 5 years ago. And this number likely undercounts value creation. Meta, for example, reports AI has increased conversions on their platform by 3 to 5%. Morgan Stanley estimates the real number could be as high as $153 billion when including indirect effects. Gauge 3, revenue growth. Green, doubling every year. This is where AI shines. Revenue growth measures how fast sector revenues are expanding. Gen AI revenues are growing at 100%, over 100% annually. That means doubling every year. Compare this to railways before the 1873 crash, 22% growth. Telecoms before 2001, 16% growth. OpenAI alone forecasts 73% annualized growth. So 2030, Citi estimates model makers could see 483% growth in 2025. The explosive growth continues to support the current investment levels. Gauge 4, valuation heat, yellow. Roughly about 32x the price to earnings average. Valuation heat measures how expensive stocks are relative to their fundamentals. The tech sector currently trades at an average PE ratio of 32 times, putting us in the yellow zone. The green zone, 15 to 25 times price to earnings. Yellow zone, 25 to 40 times price to earnings. And red zone, above 40x price to earnings. While elevated, these aren't the extreme valuations we saw in previous bubbles. The key metric to watch is forward free cash flow yields, which have fallen from 3.5% to 2.6% as capital expenditures have outpaced cash flow growth. Gauge 5, funding quality. Green, strong balance sheets. This gauge examines what type of money is funding the AI boom. Are companies using strong internal cash flows or relying on fragile speculative capital? Here's where the Magnificent Seven's financial strength becomes crucial. These companies, as of 2024, had a combined estimate of $606 billion in cash reserves, with Apple at $153.7 billion, all the way down to Meta at $47.1 billion, and they've only increased by 2025. This isn't borrowed money or speculative investment, it's cold, hard cash from profitable operations. Hyperscalers have increased their capex from 44% of operating cash flow in 2021 to 68% in 2024. But they can absorb this because they're funding it themselves. So, from an investment risk analysis, let's talk about why I consider this. There's a fundamental difference between investing in the Magnificent Seven versus AI startups. The Magnificent Seven companies have several key advantages. The first is existing revenue streams. These aren't single product companies betting everything on AI. Microsoft has Office and Azure, Apple has iPhone revenues of $201 billion annually, Amazon has AWS generating $107 billion. They can afford to experiment with AI because it's funded by proven business models. Number 2, internal capital allocation. With $606 billion in combined cash, they're not dependent on external funding or investor sentiment. If AI investment needs to slow down, they simply adjust capital allocation without facing bankruptcy. 3, multiple applications. These companies can leverage AI across existing products. Microsoft integrates AI into Office and Azure, Apple into Siri, and device features Amazon into AWS and retail operations. This diversifies their investment risk. And 4, scale advantages. Their size allows them to negotiate better deals with suppliers, spread development costs across larger revenue bases, and weather short-term setbacks. Now let's look at the startups. AI startups face fundamentally different challenges. The first is a single point of failure. Most AI startups are betting their entire existence on one AI application or model. If that doesn't achieve product market fit, the company fails. Number two is funding dependency. Startups rely on early funding rounds, and if investor sentiment towards AI turns negative, funding dries up quickly. We've seen this pattern in previous tech cycles. Competition with giants, small AI companies are competing directly with companies that have virtually unlimited resources and existing customer relationships. Number four, regulatory risk. As AI regulation increases, compliance costs favor larger companies that can spread these expenses across bigger operations. Key metrics to monitor. As an investor, here are the specific metrics you should track to identify when AI shifts from boom to bubble. First off, I'll start at the macro level indicators. AI spending as a percentage of GDP. Watch for movement towards 2%. Annual infrastructure spending, currently at $370 billion, monitor for acceleration beyond projections. And then Gen AI revenue growth, currently at 100% plus, watch for deceleration below 50%. And then there's company level indicators. CapEx as a percentage of cash flow. Hyperscalers currently at 68%, danger zone above 80%. You've got forward PE ratios, currently 32x average, red flag is above 45x sustained. And then free cash flow yields, currently 2.6%, they're concerning if consistently below 2%. And order backlogs, monitor NVIDIA and chip companies for demand signals. And then you've got market structure indicators. The funding quality, watch for shift from internal cash to external debt financing. Revenue concentration. Monitor whether AI revenues become too concentrated in a few companies. And then you've got the geographic distribution. Currently 70% of AI spending is US focused. So in terms of AI for the portfolio and the exposure, I would consider the following. The Magnificent Seven over pure play AI startups for lower risk exposure. Look, if I saw a startup I really liked and was doing well, I may throw a small percentage of my AI allocation their way. Number two, monitor the metrics we discussed, especially CapEx ratios and revenue growth. And then number three, keep cash reserves to take advantage of any major corrections. The key insight, the analysis shows we're not in a bubble yet, but the dynamics can change quickly. Having a framework to monitor these changes puts you ahead of investors who are just following sentiment. So what's the bottom line? Based on the ZAR's framework, AI is currently in boom territory, not bubble territory. We have 4 green gauges and 1 red gauge, and that red gauge industry strain is actually explainable given the explosive revenue growth we're seeing. But this doesn't mean we can be complacent. Several factors could quickly push us into bubble territory. Economic recession reducing enterprise AI spend, regulatory crackdowns on major tech companies, geopolitical tensions disrupting supply chains, and technical limitations hitting AI development progress. That's our deep dive into whether AI is a boom or a bubble. The framework-based approach gives us much better insight than just following headlines or gut feelings. If this analysis was helpful, make sure to like this video and subscribe to Intech Investments for more technology and investment-related content. Drop a comment below. Which of these 5 gauges concerns you most as an investor? Are you currently overweight or underweight AI in your portfolio? Thanks for watching, and I'll see you in the next video. And if you'd like the sources, check the description below, or see Azim Azar, Is AI a Bubble? From Exponential View, the AI Daily Brief YouTube channel, and the rest of the sources were company financial statements and earning reports, Goldman Sachs AI infrastructure spending projections, Morgan Stanley revenue estimates, and I used AI to put this together and collect some of the available Mag 7 cash balances. Please double check any figures or information cited if you're going to be using it for professional or analyst purposes. Thanks, and hope you have a great day.